All right, so if you're new to the live trading room, almost every market day we do a mid-market summary, just kind of talk through where we are, look at the patterns on the charts. We look at our Able Trend charts and we look at our bar charts. The bar charts for me kind of give me a macro view of what could potentially be happening based on kind of the big picture, looking at historical patterns. And then the Able Trend charts, particularly the 515 and the 3-9 time periods are the ones that we typically trade off of. So what I'm seeing here right now is on all three indexes, we're double stacked to the downside on our 3-9 time period. NDX has pulled back up to the sweet spot. The bar is green. It's trading right at 3-minute resistance. Michael's actually working a trade right now where he's thinking about getting into a long put, buying to open a long put on NDX, mostly because we're double stacked, meaning we have 9-minute support, 9-minute resistance and 3-minute resistance. And we're trading right at 3-minute resistance. Now the bar is green. If you want to take a conservative approach to this trade signal, you would wait until the bar turned red and closed red, and then you would go ahead and buy to open a put. You'd buy to open a put. The placement of that put, strike, and expiration that you're going to use is in large part dependent on how you want to manage your account, how much capital you are willing to put in the trade. Now, I've been emphasizing the last few days, and I want to emphasize again here, that the very first decision you need to make before you ever think about entering a trade is how much capital are you willing to put into a trade. The signals are going to be the same across multiple traders, but different traders may take different expirations, may take different strikes. Some may be deep in the money, some may be out of the money. There's no one right way to do that. I actually ran an analysis that I shared in our Profit Accelerator webinar series where I did a comparison of buying to open one contract deep in the money and comparing that to the results of buying two contracts out of the money, where you had essentially the same level of risk, same level of investment. The two contracts out of the money almost always beat out the one contract in the money. You might be in that two contract trade that is out of the money a little bit longer than the one contract trade that's in the money because of the deltas. But the bottom line here is you can trade successfully off of these signals, and you can choose a different strike and expiration than someone else. So, Michael, what strike and expiration are you considering for your NDX trade?
Um, the next week's expiration, the 4800 put.
Next week's expiration, 4,800 put. So Michael's going deep in the money on that. NDX is trading at 40. Hold on, let me just pull this.
46.49.
46.49. He's going deep in the money, so he's taking. That's probably got a delta of almost 1, doesn't it?
And 90 change, yes.
Yeah. Okay. So there's nothing wrong with that. That's the approach that he wants to take. He's going deep in the money, and he's going to leverage a very quick profit on that if and when NDX actually follows through on the signal and moves lower. Because with a 90 delta, he's going to get about 90 cents of improvement on the value of his position for every $1 movement lower. So someone else might go at the money and have a 50 delta. Someone else might go out of the money and have a 35 delta. Again, the signal is the same, folks. You need to decide what's right for your account. You need to decide how much capital you want to put in play, how much capital you are willing to put at risk. That's absolutely the number one decision. So the reason this might be a good trade is because we're at the sweet spot, and see here, the bar was green at the sweet spot, meaning right at resistance. And then the next bar turned red and closed red. And so now we're on a second red bar that looks like it will also close red and close at the bottom of the range. Now, the 515 time period, and there's a buy signal on a stock. We're going to skip that for right now, but the 515 is the same thing. You have double stacked to the downside. Now we're not right up at resistance, but that's okay. I primarily trade off of the 3.9. There's another pre-alert on a stock. But the fact of the matter is the two time periods are consistent. And we talked about that a few days ago, is looking for some consistency between the time periods on the individual index, but also looking for consistency across the three different indexes. So let's just scan across. We can see we are double stacked to the downside on all three indexes, and we are double stacked to the downside on both time periods on each index. That personally for me gives me a greater sense of confidence in taking a position. You always have a certain amount of potential risk on a trade. You always have the possibility that the minute you open that trade, the signals reverse. That happens. I can't tell you what's going to happen beyond the current signal. I can tell you what's happening historically. I can tell you where we are in terms of our double stack, in terms of our support or resistance, but I can't tell you that we wouldn't immediately bolt to the upside unexpectedly. There's always risk. But when I see all three indexes aligned in two time periods, it gives me a greater sense of confidence. So Michael's working that trade on NDX. I actually worked a trade on SPX where the bar was green. The next bar turned red and closed red, and it closed at the bottom of its range. That right there is a conservative entry. Here's a situation where the price of the index moved back up to resistance. It's trading right in the range of resistance. The bar was green. So that is saying might want to wait if you want to take a conservative approach to entry. When the next bar turned red, I still didn't necessarily want to get in just yet. I wanted to wait until the bar closed red. It did, and I went ahead and entered a position on SPX. I bought to open a 2200 put. The index is trading around 2166 right now. I think it was at 2167 when I opened that. So I went in the money, not quite as deep in the money as what Michael is doing on NDX, but I have a delta of about 68. Okay, so that means that if SPX does move lower, that the value of my position should improve, should gain by about 68 cents for each $1 of movement lower. And again, I was confident in taking that trade because, first of all, I had waited for a development of a consistent pattern. Now, over the last couple of weeks, we've had some very sketchy, very inconsistent patterns, chip chop type patterns where 1 minute we're bouncing off of support, the next minute we're bouncing off of resistance, and we continue to trade in those ranges. But right now we are consistent, and I waited until there was a pattern that developed. Now, there was a sell signal that came on back here on SPX. It would have been nice to get in based on that sell signal because you can see how clearly we followed through on that. I actually tracked that. I decided not to get into it, but I tracked it, and the price at the time that I looked at that sell signal was 41.20. The mark was 41.20 on the 2200 August week 3 put, and now it's 45.80. So there obviously was follow through, but at this point in time, you don't know where we're going, and we've just now dipped below support. So what are we going to do? I don't know where we're going from there. As it turns out, it followed through. I felt more confident once we had developed a pattern, a series of both 3-minute and 9-minute resistance points where we pulled back up from a dip to resistance and then took advantage of the opportunity to get in. So I got in right over here. This was actually a very nice sweet spot trade. I was focused on a couple of other things at the time. I had another trade in play, and I didn't take advantage of that. But this right here was a good sweet spot trade. You would have gotten in right there, right at the open of this bar, which would have been around 2168, and it ended up going down to 2165. So a 3-point move with a 68 delta is enough to grab a nice quick day trade profit. And again, we're double stacked to the downside on both of these indexes. RUT, I won't go through all the detail on that, but you can see the same thing here. Nice little sweet spot pattern, nice little follow through here, and we're double stacked on both time periods. So let me show you one other thing here, because some of you followed along with a trade I did, 3 trades that I did on ISRG. We don't trade a lot of stocks, but we've had such a chip chop pattern. That's the expression that Michael uses to describe it when we're in this very tight range. But we've had such a very tight pattern on all 3 indexes that it's easy to start looking at boredom trades, meaning I'm bored because there's not a lot going on, and so, well, maybe I'll take this trade. Well, you don't really want to do that. I mean, that's kind of a ridiculous way to trade, and you're going to get yourself in trouble when you do that. So when we get into those types of periods, and when they seem to be drawn out, which this one has been, I'll start taking a look at some of the stocks that I have historically liked to trade. And one of them that I found was ISRG. Yesterday, I saw ISRG was trading a Bollinger Band snap, and I'll show the bar chart here in just a moment. And we were double stacked to the downside on the 515. Now, we had 90-minute support below us, and so I was waiting towards the end of the day. I did get into a trade, and I was waiting towards the end of the day to see whether or not that 90-minute support printed again. It did, in fact, print again, so I decided to go ahead and exit out of my trade yesterday and just took a little day trade profit of about $400. Kudos to many of you in the live trading room, followed along with me on that. You got out, you got in for slightly better fill than I did, and you got out for a slightly better fill than I did. Some of you made as much as $700 on that nice little day trade. But then what I decided to do was I jumped back in and I chose a different expiration with a lower cost basis, and I wanted to hold that trade overnight. And the reason was because we were still double stacked to the downside, and we were still showing a Bollinger Band snap pattern. So you don't necessarily have to stick with the trade you have. You can take a profit and then re-engage a different strike or different expiration with perhaps a lower cost basis. So in my case, I started by opening a trade for about 34, I think it was 34.40. I exited out of it for 38.40, so I made $400. And then I entered a new trade for right around $28. Now, I could have stayed with the trade I had, but the risk in staying with the trade that I have is that the price of the stock could have moved higher and all of my profit could have dried up, as well as then I had the risk of the $34, $34.40 in the trade. By closing out what I had and taking the profit and reopening a new strike at only $28, I'd already locked in profit. So now I actually have a net cost basis of $24 if I take into account the profit I've already taken. So I have lower risk, but I still have the opportunity in front of me. So this morning I closed out of that trade for just under $300 of additional profit. And then as I was looking at the chart here, this is what I saw right here. I saw that the 120 daily chart was showing a sell signal. Now that hasn't confirmed yet. That sell signal has not confirmed yet. We would really need to wait until the next print, to the next bars printed, to see whether or not that's a valid sell signal. But because that sell signal is there, and because we are still trading according to the bar chart at or near a Bollinger Band snap, I decided to go ahead and jump back into the trade. So I've already taken just under $700 of profits on that trade, and we are right back into the trade and still set up for potential profit opportunity on that. So I just kind of wanted to go through that exercise with you and try to help you understand not only the timing of the entry and the selection of that, but why would I not just hold the original trade that I had instead of getting out of it, taking the profit, getting out of the second one, taking the profit, and then entering a third one. And also between those three trades, I changed the expiration and I changed the strike. The trade I started with this morning was a September expiration at a 720 put. The trade I hold right now is an October expiration, so I gave myself another 30 days to see some follow through on this, and it's a 700 expiration. So the price I paid for my 700 expiration was right about what I had sold the trade for earlier today to close, but I went from September to October. So in my mind, this is a better trade because I have more time and I still have the same amount of money really committed to that trade. All right, so let's take a look at the bar charts here. I want to give you my perspective today. Okay, so I'm going to talk about the three indexes, but let me just first of all finish off our discussion about ISRG. So yesterday I took the trade. I first took the trade because of the Bollinger Band snap on the 1-year daily. The fact that ISRG had hit a new all-time high with that Bollinger Band snap, and the fact that there was an oops pattern in play, which means that the price of the stock would need to trade back down to 675.81 in order to satisfy that oops. So we're no longer in a Bollinger Band snap pattern. Because we have moved below the Bollinger Band. And that movement is what allowed me to exit out of the first two trades that I placed. The third trade was influenced, like I said, by the fact that we're double stacked to the downside on the 5-15-minute ISRG chart, as well as the sell signal that has appeared, which has not yet been validated on the 120 daily. But another factor is we still have the oops pattern to satisfy here. So with the stock trading at 692 and it needing to trade down to 675 in order to satisfy the oops, there's, in my opinion, still some good opportunity there. But there's one other factor, and I don't recall if I shared this yesterday, but when you look at a 5-year pattern, we're trading right at the upper 2 standard deviation Bollinger Band. So basically this weekly bar has been a very strong Bollinger Band snap pattern this week. Now, you only need this close price tomorrow. So when the week closes, you only need this close price to be at or slightly below where it's currently trading in order for this to be a very strong weekly bearish divergent bar. Bearish divergent bar would indicate that there was a lot of strength to push the price higher, which it did, but not enough strength to maintain it there. So the fact that we look like we're setting up, and it's not confirmed yet, it won't be confirmed until the close of the market tomorrow, which is Friday, but it looks like we're setting up for a bearish divergence on the weekly chart. That plus the fact that we need to move down to 675 in order to satisfy the oops, says I was willing to take another position on ISRG. So I just wanted to understand clearly why I'm choosing to trade in and out of this position. And you can choose to follow along if you want to. So let's take a look at NDX. Now NDX, I've not made any adjustments to my channels today. As you know, I will tweak my channels a little bit as the price continues to move, because what I'm in search of is that natural level of resistance that the market is defining for us. Natural level of resistance that the market defines has nothing to do with lines on a chart. It has to do with a price point where it reaches a high, the index price reaches a high, and every price point before it and every price point after it has a lower high. That is a market-defined level of resistance. It's not because somebody drew a line out here and said, here's a level of resistance. So I'm in search of the next natural level of resistance. By the way, Able Trend is just flashing a 30-minute sell signal, 30-minute sell signal on ISRG, 30-minute sell signal. All right, so I think we might like that trade that we've got in play. So natural level of resistance is going to be defined by the market. And what I do then is I connect the dots. I do the elementary school work of just connecting the dots. The dots are, let me find all the natural levels of resistance through a long time period and see what that pattern looks like. So yesterday's high was 46.65. Today's high is 46.69. So we have a new high today. So a couple of things are in play. Right now, that is looking like it could possibly be a natural level of resistance today. But we won't know that really until we get 2 or 3 days beyond today and we see a confirmation of declining price points. But there's something else that's going on here. If I zoom in, you can see this pretty clearly. We have a bearish divergence bar in play right now. It doesn't mean that it will be a bearish divergence at the end of the day, but it is a bearish divergence right now. And that's because the high today is higher than yesterday's high. And the close, or the current price of the bar, the current price that we're trading at, is in the bottom 50% of the day's range. Well, that higher high today, although it was a higher high, it was only about 4 points higher than yesterday, which means it's still trading right at that line of resistance. And when I connected the dots previously to yesterday's high and now today's high, that today, the high today is a natural level of resistance defined by the market, and it ties back to 2 to 3 prior natural levels of resistance. One of them was on the 2nd of December, and one of them was on the 3rd of November. Now there's another one out here that was on the 29th of December. It wasn't really right at that level of resistance, but you can see here that it was a natural level of resistance because the price, go back there, the price of the index moved higher, formed a high, and then everything fell off to lower highs after it. So right there, that is a natural level of resistance. Now, it's not necessarily touching this line that I've drawn across the chart, but what you're really trying to do here is to capture as many of those natural levels of resistance as possible to have some idea of what the parameters of trading are for this index. So here is one we already talked about. Here's one. There's actually another one right here on the 7th of December where the high, it's a high, let me just see something, 47.22, 47. No, this one right here on the 4th of December, where it's the highest high in this range. But you can see that there was a series of highs in here that are really defining this. So I'm going back there, I'm grabbing those, I'm just connecting the dots, putting a ruler across all those and saying, if that previously defined a level of resistance, and if we validate, test and validate that resistance here at this level of trading and start to move lower, it could then imply that the next real cycle or the next trend that we're going to get into is a declining trend. Now, I don't mean an overall declining channel, big picture channel. I mean just a movement lower within the already defined rising channel. And one of the things that my team and I were talking about before the market opened today is if you go back to the low on the 27th of June and you connect to today's high. I was doing it with yesterday's high before the market opened, but let's connect to today's high. That's the range of movement since we've been in this rising pattern. You put a Fibonacci retracement grid, simple little tool, Fibonacci retracement. There are three levels of retracement that are very commonly understood to be pivot points, shift points in the price. The first is the 38.2% retracement. If we move down to the 38.2% retracement and stopped there, then it's possible we could see the index move higher and take out the previous high. 50% retracement and 61.8% retracement are also levels of measurement. So let's just look at a 50% retracement. What if NDX stalled out right here, reached a point of exhaustion, and then declined down to 50% of this entire rising pattern? Well, that puts the price of the index down around 44.19. 44.19, it would be a considerable move lower, and there are going to be some big profit opportunities if and when that occurs. I'm not saying that's going to occur, but if we do start to see a movement lower and we break below support of this rising cycle, we're going to be looking very carefully at price levels at 38%, 50%, and 61% areas to determine what if anything, the market wants to tell us about what we should do next. The other thing about NDX is we've got OOPS patterns. We have multiple OOPS patterns in this rising cycle. The lowest of them would require the index to move down to 42.91.43, 42.91 in order to satisfy that OOPS. So there's a lot of potential movement lower. At least as of right now, we appear to be stalling at this level of resistance, but this could just be taking a breather before we move higher. We don't know that yet. So this is where we really need to exercise patience, but this is why we rely almost entirely on the Abel trend charts to decide when we want to open new positions. Because the 3.9 and the 5.15 charts are going to give us cues to enter a position. The bar chart here on a 1-year daily or big picture view, that's just kind of the macro view to say, in this case, I would feel very confident getting into a short position, but I'm going to wait until a cue or a signal for a long position is fully confirmed. It doesn't mean I will ignore a position to go long. It just means, in this case, I'm going to wait until it's fully confirmed. Let's take a look at SPX here. Very similar situation. You can see right here that we've stalled out, at least as of right now, we've stalled out at this sideways line of resistance, have not done any adjustments to the channel as of today. Let's see where we are in terms of highs. Yesterday's high was 2175.63. Today's high is a lower high. So 2175.63 is a new all-time high for SPX. So we've drifted a little bit lower off of that, but it looks like we may have stalled, at least as of right now, at that level of resistance. And you can see here how I take that natural level of resistance that formed yesterday and tie it back to other multiple other natural levels of resistance. You can see here we got a lot of downside potential, but there's a level of support naturally at the lower Bollinger Bands, and it's doubtful that if indexes start to form declining patterns that we're going to see it dump off all at once. We're more than likely going to see it do what it normally does. It cycles down, it cycles up, it cycles down, but the overall slope of that pattern is to the downside. And then let's take a look at RUT. RUT, it's so obvious to me that RUT has stalled out here for the last 8 days or so at this line of resistance, a natural line of resistance. You know, if there were no lines on the chart, you would be able to see these price bars right here and scratch your head and say, well, geez, it looks like the price of this index can't seem to move above that certain level. Well, that's key in my opinion, because I can now take my pencil, figuratively, and draw a line across those and then go back and see how many other natural points of resistance I can tie into. And with RUT here, you can see there was a series of price activity here. There's a series of price activities here. There was price activity here. All of those tie into the series of price bars that we've seen for the last 8 days. And it's fascinating to me that that price level is just one that RUT cannot seem to break above. It has not done it since the very first price natural level of resistance formed, which was on the 17th of September of 2015. Now, there were higher prices before that, but ever since we sold off and then came back up, we seem to be stalled at this level of resistance. Doesn't mean that we won't break above it, but the longer that level of resistance has been in place, and the more you see this type of pattern where it just seems to stall right at that pattern, right there, folks, is my comfort level in then looking at my Able Trend charts, and there's a signal to go short. I'm going to feel very confident, maybe even jump the gun a little bit on that short signal, not wait for it to confirm on Able Trend. But if there was a signal to go long on Able Trend, I'm not saying I would not take that. I'm just saying that if I see a signal to go long, I see a buy signal, or I see a blue bar that hasn't closed yet, I'm going to wait for final and absolute confirmation of that signal before I take that long signal. I will be willing to take that long signal, but I'm just going to be very careful on my entry, and I'm influenced entirely by this pattern right here. So, trading is about taking in data. Trading is about doing your homework, doing your due diligence, and just finding those data points that are going to help you understand more about what to do. Beyond that, it is about deciding how much capital you're willing to put at risk. And you can define it either by day or by trade, okay? But you need to have some idea of how much you're willing to put at risk. Far too many traders start by finding a good trade. They jump into the trade, or they may ask somebody like myself or Michael or Allison, hey, how many contracts should I trade? I can't answer that for you. I can only tell you that you need to look at your account and look in the mirror and decide for yourself how much risk you are willing to put on. There's a great quote by Jesse Livermore that I saw last night, and what Jesse Livermore said: losing money is the least of my troubles. A loss never troubles me after I take it. I forget it overnight, but being wrong, not taking the loss, that is what does the damage to the pocketbook and to the soul. And the reason I say that, and I share that quote with you, is because if you recognize clearly that you're going to have losses, you're going to have some trades that are going to lose, then you know that you don't want to trade, you don't want to put at risk more capital than you are willing to lose. And if you have all of that clear and you are at peace about how you are trading, then proceed using these technical signals, take every single trade that you feel confident in and let them just play themselves out, right? Base hits are small trades, day trades, or locking in within the same day, small profits multiple times and recycling your capital. But every single day and every single trade, you must absolutely begin with, how much am I willing to risk? What is my threshold of risk? And I cannot exceed that, no matter how fantastic and absolutely guaranteed I think that this next trade signal is going to be. One of the things that you can guarantee yourself, or I think I can guarantee you, is if you miss this signal, there will be another signal. If you miss this trade because you weren't sure about it, or you didn't want to put the capital in, you already had a trade in play, whatever reason, just be confident that there will be another trade. There will be another trade signal. Just when you think you missed opportunity, opportunity represents itself. You've got to just find a place in your mind and in your thinking as a trader to be at peace. And it, in my opinion, all starts with how much capital you're going to trade. So many of us start by teaching those of us who teach others how to trade. We teach you how to find the signals. We teach you how to find the stocks, the indexes. We teach you the strategies. But it's so apparent to me that that needs to start with the thought about how much you're going to risk. What's your risk today? And your risk may be entirely different than somebody else's risk, but the same signals can give you each a nice profitable trade. So I enjoy going through my charts. I enjoy going through my bar charts every day and looking at whether or not the patterns are changing or the patterns are confirming what I had previously seen. Because if I have that solidly in my thought, then all I have to do is, to keep my trading as simple as possible, is just look at my 3-9 and 5-15 Able Trend charts. I already know, without even having the bar chart up, I already know where we are relative to a long-term line of resistance on all three indexes. Now all I'll have to do is keep my trading simple, watch my 3-9 minute charts, my 5-15 minute charts, look for a level of consistency between the two time periods, possibly even a level of consistency between the indexes, and then just go open a trade. I already know how much I'm willing to put at risk, so I know whether I can open one trade or two trades, one contract or three contracts. That's all entirely up to you. And then follow the signals, follow Able Trend. Able Trend is going to tell you when to get out, although Michael and I both most always get out when we have a certain amount of profit, because we believe in base hits. Peter, one of our clients in the trading room, he stayed the course yesterday on a rising bias trade and never exited out of the trade because Able Trend never told him that it was time to exit out. And finally, he got out of the trade for a $22.30 profit, which was just a fantastic profit for one day, all within the same day. He traded one contract, so he made $2,200 on that trade. This can be very simple. Trading can be as complicated as you want it to be, and it doesn't need to be complicated. If you go through and do your bar chart analysis, just to give you a macro view, and you feel confident in your understanding of that, then you really don't need to be bouncing around between multiple things. All you need to do is monitor your Able Trend 3-9 and 5-15 minute charts. All right, I hope that's helpful to you folks. It's an analysis that I do every day anyway, and I just thought that I would share my analysis with you and some of my thoughts. These are the types of things that I talk about with my team, Michael and Allison and Aaron. We trade together every single day, and it's a privilege to have all of you in the trading room here with us and follow along with our trades. And it's even it's even more fun when those of you in our live trading room share with us what you just traded, the profits that you took, and some of the trades that you did on your own, some of the trades that you followed along with us. It's just a lot of fun to hear about those and celebrate with one another the wins that we have. So I hope you have a great rest of your day, and we'll be back here again tomorrow with another update.